Hi friends, a small intro video before you see the main video. Uh, these are concept revision videos for AFM, costing or FM. Objective is very simple. Learn concepts with limited amount of time. Post concepts, do practice. These are applicable for first time learners as well as new learners, and these are taken from my regular or exam oriented sessions. Now you move to the main video. Okay, let's now start with chapter 6. In the financing decision, listen for some time, nothing for it. In the financing decision is money to be raised. We learnt about cost of capital. Cost of capital was trying to find out what is the cost for every item of the capital structure. There's a chapter 5 which evaluates the capital structure, which we are yet to do. We will do that in some time, maybe in the after this chapter is over. I'm starting with leverages chapter, smallest chapter in the entire material and the most important chapter. Very, very frequently tested. One question 100% comes from this area in most of the exam. Concepts are going to be very, very limited. By now you would have understood even the first chapter which we did, cost of capital. Concepts were limited, got over at some stage. We practiced a lot of questions. Ratio analysis, same happened. This the concept is not even much, only 3-4 concepts are there. Let us try to understand them first. Now every organization tries to put in some efforts, and with the effort they want to get some results. Leverages basically say the results which you get and the efforts which you put in may have something called as a disproportionate returns. What is this disproportionate? For example, let us take sales. Sales is 1 lakh, doubles to 2 lakh. If sales is doubling, ideally PAT should double. Sales is doubling, ideally PAT should double. Sales is the effort I put in the company. I put my efforts to increase the sales. Ideally, profit should double. Instead of doubling, profit may triple here. Profit may triple, or profit may go up by 250%, 300, 400, some number. If that happens, leverages exist in a company. Leverages exist. What is leverages and all understand? Let's understand in some time. 1 lakh is becoming 2 lakh. Profit should ideally double. Now, in this less variable cost, 60,000, 1 lakh, 20,000. This is called contribution. You would have learned in marginal costing. Contribution is 40, 80. Less fixed cost, 20,000. Can I write 20,000 or 40,000 this side? 20,000. EBIT. EBIT 20, 60. Sales has doubled. EBIT has tripled. Sales has doubled. Sales has doubled. EBIT has tripled. Sales has doubled. EBIT has tripled in this case. Able to understand this? Sales is doubling. EBIT is tripling. EBIT is tripling. This is the first understanding. Okay. Ideally, EBIT should also double, but EBIT is not doubling. EBIT is becoming 3 times. Reason, fixed cost. Reason is fixed. You remove the fixed cost, 0, 0, 40 would have doubled. 40 would have doubled. If you have fixed cost, sales may double. EBIT may triple 4 times, 5 times, anything can happen. Then interest 5,000, 5,000, 15, 55. Assuming tax is 0 for the time being. Okay. Assuming tax is 0. 15 has become 55,000. 15 has become 55,000. 55 by 15 is 3.67 times. Sales doubled. Profit has become 3.67 times of sales. Profit has become 3.67 times. 3.67 times of sales. Why is this existing? Because of a term called leverage. Because of a term called leverage. It is a good as well as a bad. It is a good as well as a bad. What is bad? Sales became half. Sales became half. Should profit half in sales? Ideally, but profit instead of becoming half may go down by 100, 120, 130. It can become negative also. Sales became half. Profit is down by 150%. 150 down means positive will become negative. Positive will become negative. Variable cost is half. Contribution is half. Will fixed cost become half? What is EBIT? Sales became half. EBIT is down by 100%. Sales became half. EBIT is down by 100%. Sales is half. EBIT is down by 100%. EBIT is down by 100%. From this, interest is 5,000 and this is negative 5,000. This is negative 5,000. Sales became half. I was thinking profit will become half. From 15,000, profit has become negative 5,000. Profit has become negative 5,000. From 15,000, profit has become what? Negative 5,000. Profit has become negative 5,000. This is the scenario which is panning out here. Profit may become half. Profit may go down by 100%. Profit may go down by 120% when sales is going down only by 50%. Good part, sales increasing, profit doubling or tripling. Sales going down, profit even becoming negative. That's the bad part. There is a good part as well as a bad part. Leverages is technically called as a double-edged sword. You may get benefit. You may also get penalized. You may also get penalized here. Benefits are also there. Penalization can also be there. Why is this happening? Rewards. Rewards are disproportionate to the efforts taken. The rewards has a disproportionate change. Disproportionate change to the effort taken by me. What is effort? Increase or decrease in sale. I increase my effort by 20%. Reward should increase by 20%. Reward is profit. Effort 20% increase. Reward 80% increase. Reward is 80% increase. Effort 20% decrease. Reward 80% decrease. Reward is 80% decrease. Reward increase or decrease in PAT or EPS arises due to two reasons. One is your operations. What is operation? Is marginal costing. What is marginal costing? Sales less variable cost, contribution less fixed cost. We call profit there. That is called EBIT. That's called EBIT. So till EBIT, there can be an item called fixed cost, because of which reward can be disproportionate. Or below EBIT, you can have operations, you can have fixed cost. Capital structure, you can have fixed capital. What is fixed capital? Is debt and preference. Preference can also impact. I have not explained in detail the formula and all. Debt can be there, preference can be there. If a company has zero fixed cost, zero debt, zero preference capital, increase in sales percentage is equal to increase in profit percentage. Increase in sales percentage is equal to increase in profit percentage, provided no change in the some net profit margin, or all this will remain same. If two condition, no fixed cost, variable cost will double, contribution will double, no fixed cost, EBIT will double, no interest, EBT will double, tax be there, tax will also double, EAT will also double, no preference dividend, EAES will double, EPS will double. Everything will double if one item, two items are not there. One is fixed cost, second is fixed capital. Fixed cost, fixed capital. Fixed cost and fixed capital. Able to understand till this? Any doubts on this? The reward which I get is going to be disproportionate to the efforts which I take. The reward which I get is disproportionate to the efforts which I take. If I'm able to get more reward, happy. but we also be ready to have more penalty. What is penalty is sales going down, you'll be penalized more. Any doubts in this? Okay. Let us take the example this side. How much is the sales increase? How much is the EBIT increase? Percentage. EBIT increase, what is the percentage? Sorry? Increase. Who is it 66.6? It has to be more than 100. 200% increase. Increase I asked. What is 200%? 60,000 minus 20,000 divided by 20,000. The old value. Divided by 20,000. Sales 100% increase are doubled. Profit 200% increase are tripled. Clear? So, the ratio of reward to the ratio of effort. Reward is 200, effort is 100. Ratio of reward to the ratio of effort. Ratio of reward to the ratio of effort. Ratio of reward to the ratio of effort. So, in this example, reward, I'm talking about EBIT as of now, okay? EBIT increase 60 minus 20 by 20 old value, 200% increase. 200% increase. Effort, which is called sales. Effort, which is called sales. Effort, which is called sales. In my example, sales part is 2 minus 1 by 1 into 100, 100% increase. So, effort is increasing by 100%, reward is increasing by 200%. Any doubts till this? And this effort and reward is measured through operating leverage. Listen, what is operating leverage is because of the operations, how much extra reward you can get or how much extra penalty you can get. Reward alone you don't see, penalty also you see. What is penalty? Sales going down by 10%, EBIT will go down by 20%. Sales going down by 10%, EBIT will go down by 20%. Sales down by 50%, EBIT down by 100%. So operating leverage is percentage change in EBIT or percentage change in sales 200 by 100 two times. 200 by 100 two times is the operating leverage. 200 by 100 two times is the operating leverage. 2 times is the operating leverage. Percentage change in EBIT by percentage change in sales. Percentage change in EBIT by percentage change in sales 2 times. 200 by 100. 200 by 100 two times is the operating leverage. 2 times is the operating leverage. 2 times is the operating leverage. What does 2 times mean? If sales go up by 1%, EBIT will go up by 2%. Sales go up by 100%, EBIT will go up by 200%. Sales goes up by 200%, EBIT will go up by 400%. Sales goes up by 200%, EBIT will go up by 400%. Sales goes up by 400%, EBIT will go up by 800%. For example, 1 lakh, I make it 3 lakh. 3 lakh means 200% increase. 3 lakh is 200% increase. 1 lakh has become how much? 3 lakh, 200% increase. EBIT will go up by 400%. EBIT will go up by 400%. 3 lakh minus variable cost will be 1 lakh 80. contribution will be 1 lakh 20, sorry, not 1 lakh 80, yeah, 1 lakh 80, 1 lakh 20, and this will become 1 lakh. 1 lakh is 5 times 400% increase, 5 times and 400% increase, 400% increase. Reward very high, disproportionate to the efforts taken. Reward is disproportionate to the efforts taken. Clear? Okay. Second formula is same answer you will get. Contribution divided by EBIT. Contribution. The formula of 2 times is the logical explanation. Formula to calculate this 2 times is also contribution 40,000, EBIT 20,000. Contribution 40,000, EBIT 20,000. Answer is the OL will keep changing. What does keep changing? If you apply the OL in this, you will get a different operating leverage. You will get a different operating leverage. Contribution divided by EBIT is how much? 2 times. Contribution divided by EBIT is 2 times. Contribution divided by EBIT. What is the logic of the formula? Logic is very simple. Contribution divided by contribution minus the reason for the operating leverage, minus the reason for the operating leverage, minus the reason for the operating leverage. Operating leverage exists if you have fixed cost. No fixed cost, no operating leverage. No fixed cost, no operating leverage. So minus fixed cost. Zero fixed cost, contribution by contribution. Any doubts till this? Clear? Let us take this number alone. Can you tell me what is the break-even point? EBIT is like profit, marginal costing. Tell me the break-even point. Break-even point is fixed cost divided by PV ratio. Fixed cost divided by PV ratio. Fixed cost divided by PV ratio, which is how much? 50,000. 50,000. I'm not getting into the formula of that and all. Okay. 50,000. 50,000 is 50% of sale. 50,000 is 50 percentage of sale. 50 percentage of sale. If break even is 50%, margin of safety is also 50%, and operating leverage is equal to 1 by margin of safety percentage. 1 by margin of safety percentage. 1 by margin of safety percentage. 1 by margin of safety, not BEP percentage. BEP is also 50, margin is also 50. 1 by margin of safety percentage. Now, I show all the formula here. Contribution by EBIT, percentage change in EBIT by percentage change in sales. 1 by margin of safety. 1 by margin of safety. Most important is this. OL of 2 times would mean EBIT will increase by 2% for 1% change in sale. EBIT will increase by 2% for what? 1% change in sale. 2% for 1% change in sale. Let us understand this again. Particulars. You need not write anything. Amount, okay? Sales 10 lakh. Sales is 10 lakh less variable cost 4 lakh. Contribution 6 lakh less fixed cost 2 lakh. EBIT, otherwise called profit for the time being. Okay, EBIT, otherwise called profit for the time being. Change and revised amount. My EBIT for the time being is 4 lakh. Let us call it as profit only for the time being. Okay. Now, operating leverage is equal to contribution divided by EBIT. Operating leverage is contribution divided by EBIT. What is the contribution in this example? 6 lakh. EBIT, how much is this? Okay. Any doubts in this? Okay. Sales going up by 200%. Sales is going up by 200%. Any number I can take. I'm not doing any calculation. EBIT will go up by 200 into 1.5 times. EBIT will go up by 200 into 1.5 times. So 300%. What is this? 10 lakh plus 200% in the calculator. I'm not writing variable cost. I'm not writing contribution. I'm not writing fixed cost. Profit will be 4 lakh plus 300%. 4 lakh plus 300%. 4 lakh plus 300%. 4 lakh plus 300%. What's the number you get? Now let us understand the in between part. Variable cost is 40%. Variable cost is 40%. So this is 12 lakh. Contribution is 18 lakh. 2 lakh. Any doubts in this? Now tell me 18 by 16 is how much? 1.125. OL will keep changing. Different levels, okay? From 30 lakh if any change happen, not from original 10 lakh. From 30 lakh if any change happen, 1.125 is the link. 1.125 is the relationship. 1.125 is the relationship. What is 1.125? Listen. I add a change revised amount. Sales is down by 50%. Sales is down by 50%. Listen, EBIT will be down by 50 into 1.125. 50 into 1.125. EBIT will be down by how much? 50 into 1.125. Tell me the percentage. Sorry? Into 1.125. We will do the detailed calculation, but just the understanding you need to have. The OL will keep changing. If you are applying the change on this 10 lakh, then use the 1.5 time. If applying the change on 30 lakh, use 1.125 as operating leverage. Use 1.125. What will happen? 30 lakh minus 50% in the calculator. 15 lakh. What was the, okay, 16 lakh minus 6.25. Minus 56.25. How much? 7 lakh. Able to understand the numbers? 7 lakh. Now, this is 40%. 6 lakh. Contribution 9 lakh. Any doubts in this? Yep. Ignore this in between. Compare these two. 50% increase. 10 lakh, 15 lakh. 10 lakh. From 10 lakh, it is a 50% increase. This will be 50 into 1.5, 75% increase. 50 into 1.5, 75% increase. From 10 lakh. From 10 lakh, if you see 50 and 75. From 30 lakh, if you see 50 and 56.25. 50 and 56.25. Different ways of looking at the same example. Okay. Same example. Able to understand what is operating leverage? Operating leverage basically say the reward. Reward is what? Reward in the form of EBIT is going to be disproportionate to the efforts being taken. Disproportionate to the efforts being taken. All this is related to marginal costing. All this is related to marginal costing. Then after EBIT comes our financial management, which is interest and other thing. Any doubts till this first? Any doubts in this? Understood till this? The first part is contribution by EBIT, percentage change in EBIT by percentage change in sales, 1 by margin of safety. Any of the three formula can be used. Interpretation is OL 2 time means sale go up by 1%, EBIT go up by 2%. Is it up only? No, down also possible. Down also possible. Any doubts till this? Okay. Then comes the after EBIT. After EBIT, we have interest, which let's assume is 1 lakh. Interest is 1 lakh. EBT is 3 lakh, Axis, or let me use not, just give me a minute. 3,000, okay, I'm changing the number. 3 lakh 20, 3 lakh 20, Axis 50%, Axis 50%, 1 lakh 60, EAT 1 lakh 60, EAT is 1 lakh 60, preference dividend, give me again a minute. $80,000. I may change the number if I want, okay? I may change this number if I want later because I don't want to work with any decimals in the calculation, okay? So let us make it 60. EAES 1 lakh, number of equity shares 10,000, EPS. Ideal thing in the end company wants is what will be the impact on earnings per share. What will be the impact on earnings per share? Other things and all doesn't even make any difference to us. In the end, tell me what is happening to earnings per share. That's the end result. Okay. If I expand this table this side, 3,000, get 1520. I get 1520. Axis, tell me what is 50%. 760, 760, 60, 7 lakh, 10,000. Now, sales went up by 200% in the beginning. Sales went up by 200%. EPS is going up by 600% here. EPS is going up by 600%. EPS is going up by 600%. Sales change 200. EBIT change 300. EBIT changes 300. EPS changes 600. What is 600? 70 minus 10 by 10. 70 minus 10 by 10. Any doubts till this? Any doubts on this? Okay. Financial leverage is equal to percentage change in EPS by percentage change in EBIT. Now listen. Operating leverage formula is ending of operations. Ending of operation means EBIT is the end in the income statement. EBIT is the end. Starting of the operation, which is sales. End by start. Financials end with EPS, start with EBIT. Financials end with EPS, start with EBIT. So percentage change in EPS is 600. This is 200. 3 times. 3 times. This 3 times I can calculate using another formula. I'll summarize it. First, we'll just understand the concepts very clearly. Financial leverage is equal to, what is the formula for operating leverage? Contribution minus what is creating it, fixed cost. Let us use this as the start. EBIT divided by EBIT minus what is creating it. What is creating it is interest. What is creating it is also is preference dividend. Only thing is dividend comes after tax. So they say no, please bring it to before number by dividing 1 minus tax rate. Dividing by 1 minus tax rate. Dividing by 1 minus tax rate. This will be 3 times in the original example. This will be 3 times. Original numbers, okay? Original number, it will be 3 times. What is the formula? EBIT divided by EBIT minus interest minus PD divided by 1 minus tax rate. I'll explain again with one more example. Original example, EBIT is 320, 320 minus what is creating it is interest, minus what is creating is PD divided by 1 minus 0.5. PD divided by 1 minus 0.5. 1 minus 0.5. PD divided by 1 minus 0.5. This you get 320, 240. Sorry, what was the, not 320? EBIT was 4 lakh. EBIT was 4 lakh. EBIT was 4 lakh. Sorry, 4 lakh minus 4 lakh divided by 2 lakh. Is it 2 lakh? Just give me a minute. Okay, 300% increase, 600% increase, 300% increase and 600% increase. Give me a minute. What did I write here? I'm sorry about it, friends. Okay, 300 2 times. 300 it was 2 times. Percentage change in EBIT was 300 2 times, and this formula is also giving us 2 times. This formula is also giving us 2 times. Any doubts in this? Any doubts in this? I'll repeat again. My sales went up by 200%. EBIT went up by 300%, 1.5 times extra. EPS went up by 600%, 2 times extra. 2 times extra. 2 times extra. Coming to the formulae, financial leverage formulae, EBIT divided by EBIT minus interest minus PD divided by 1 minus tax rate, minus PD divided by 1 minus EBIT minus interest is called EBT. EBIT minus interest is called EBT, or percentage change in EPS by percentage change in EBIT. Percentage change in EPS divided by percentage change in EBIT. Percentage change in EBIT. I want to explain this one more time with the formula. Listen. Let me cancel all of this. Change now is 100%. Change now is 100%. Operating leverage is equal to contribution by EBIT. Operating leverage is contribution by EBIT, which is 4 lakh divided by 2 lakh. Sorry. 6 lakh. 6 lakh divided by 4 lakh. 1.5 times. 1.5 times. Financial leverage is EBIT, which is 4 lakh divided by EBT, which is 3 lakh 20, minus preference dividend divided by 1 minus tax rate. Preference dividend divided by 1 minus tax rate, which is 1 lakh 20. In the end, you get, without doing any calculation, this is 100% increase. EBIT will be 100 into 1.5, 150% increase. EPS will be 150 into 2 into 2, 300% increase. 150 into 2, 300% increase. In the calculator, 10 lakh plus 100%, 4 lakh plus 150%, 10 plus 300%. This will be the numbers. You do the detailed statement. This will be the numbers. 10 plus. I'll do the detailed statement now, but without even doing the statement, I got the numbers. I'm again repeating. Sales is doubling. EBIT will go up by 150%, 100 into 1.5. And EPS will go up by 150 into 2, 300%. EPS will go up by 300%. Variable cost is 8 lakh. Contribution is 12 lakh. This is 2 lakh 80,000, 9 lakh 20,000, 4 lakh 60, 4 lakh 60, 60,000, 4 lakh 10,040, 4 lakh 10,000 and without doing the income statement. What is the purpose of doing all this calculation? To understand how risky is the company. What is risky? If you have a very high operating leverage and you have a very high financial leverage, you are having trouble. You are having trouble. Bharadwaj Institute may have a high operating leverage if you have high fixed cost. And if you have high fixed cost, students go down by 10%, we may report a huge fall in profit. We may report a huge fall in profit. Huge fall in profit. Able to understand the concept? I'll repeat again the concept. Operating leverage measures, participate, operating leverage measures what? Percentage change in what? Percentage change in EBIT for percentage change in sales. Percentage change in EBIT for percentage change in sales. Percentage change in EBIT for percentage change in sales. This is the first formula. The real formula is contribution divided by EBIT. The third formula is 1 by margin of safety. 1 by margin of safety. Interpretation is OL of 2 times would mean, OL of 2 times would mean that if sales go up by 1%, EBIT will go up by 2%. Sales go up by 1%, EBIT will go up by 2%. Real formula you write somewhere. Operating leverage formula is starting point of, sorry, that's the denominator, ending point of operation divided by starting point of operation. Ending point of operation divided by starting point of operation. Ending is EBIT, starting is sales, and add a percentage. Ending is EBIT, starting is sales. Ending is EBIT, starting is sales. Marginal costing income statement starts with sales, ends with profit, which is called EBIT. That is operations. That is, in marginal costing, what you did is cost accounting, and it is related to operations of the company. Financial leverage, percentage ending point of financial, starting point of financial. Ending point of financial, finances end with EPS, starts with EBIT. Before EBIT, I'm not bothered about what happens in financial management. Percentage change in EPS by percentage change in EBIT. EPS, EBIT. Starting point, ending point comparison. Clear? Any doubts on this? Or OL equal to contribution divided by contribution minus what is creating OL. Minus what is creating OL. What is creating OL is fixed cost. This is another way of understanding. Contribution divided by contribution minus what is creating operating leverage. What is creating operating leverage? What is creating operating leverage? Clear? Financial leverage is equal to EBIT divided by EBIT minus what is creating financial leverage. What is creating financial leverage? What creates is interest and PD. PD obviously you have to divide by 1 minus tax rate. This is just for your understanding. Okay, this is how I remember the formula. I don't by heart the formula and all. Understand logic known, you will remember the formula. What is creating financial leverage? What is creating financial leverage? What creates is fixed capital, which is interest and preference dividend. Interest and preference dividend. Any doubts on this? Clear? Able to understand this? Got clarity? Any doubts till this? Last is you need not write, okay? CL equal to OL into FL. OL into FL. This is the formula. I can expand the formula. What is the formula for OL in percentage change? I said percentage change in what? Percentage change in EBIT by percentage change in sales. Ending point and starting point. What is financial leverage? Percentage change in EPS by percentage change in EBIT. Combined leverage is the starting point of income statement, ending point of income statement. Income statement means both operation and financial. Starting point of income statement, which is sales, ending point of income statement, which is EPS, end by start. This is one formula. One formula is what? Percentage change in EPS by percentage change in sales. Percentage change in EPS by percentage change in sales. Other formula is contribution divided by EBIT, EBIT divided by EBT minus PD divided by 1 minus tax, contribution divided by contribution minus what is creating OL and FL minus what is creating OL and FL. What is denominator? Contribution minus fixed cost minus interest minus preference dividend. Minus fixed cost minus interest minus preference dividend. Minus fixed cost minus interest minus preference dividend. This is combined leverage. Combined leverage is all the three together. All the two together. All the two together. Able to understand this? Any doubts in this? Operating leverage, contribution by EBIT, percentage change in EBIT by percentage change in sales, 1 by margin of safety, EBIT by EBIT minus interest minus preference dividend, ending point by starting point, contribution by EBT minus contribution by contribution minus fixed cost minus interest minus preference dividend, minus fixed cost minus interest minus preference dividend, or end point by start point. Percentage change in EPS by percentage change in sales. Percentage change in EPS by percentage change in sales. Any doubts on this? Any doubts on this? Tell me the formula for operating leverage. Percentage change in EBIT by percentage change in sales. I don't want the other formula. Okay. Percentage change in EBIT by percentage change in sales. Only percentage change formula you have to give. Combined leverage formula. Percentage change in EPS by percentage change in sales. Financial leverage formula. Percentage change in EPS by percentage change in EBIT. Operating leverage formula. Percentage change in EBIT divided by percentage change in sales. Combined leverage formula. Percentage change in EPS divided by percentage change in sales. Operating leverage formula. Percentage change in EBIT divided by percentage change in sales. Financial leverage formula. Percentage change in EPS divided by percentage change in EBIT. Combined leverage formula. EPS divided by percentage change in sales. Operating leverage formula. Percentage change in EBIT divided by percentage change in sales. Financial leverage formula. Percentage change in EPS divided by percentage change in EBIT. This is one category. Okay. Second category. The numerator is contribution. Denominator is what is creating. Denominator is what is creating when it is operating leverage. Financial leverage, EBIT minus what is creating. Combined contribution minus what is creating. What's the formula for operating leverage? Contribution divided by contribution minus fixed cost. Minus fixed cost. What is formula for combined leverage? Contribution divided by contribution minus fixed cost minus interest minus PD divided by 1 minus tax rate. PD divided by 1 minus tax rate. You can give a simple formula as EBT minus this. Financial leverage formula. EBIT divided by EBIT minus interest minus PD divided by 1 minus tax rate. Minus 1 minus tax rate. What's the formula for combined leverage? Contribution divided by contribution minus fixed cost minus interest minus PD divided by 1 minus tax rate. When I write the formula, I'll write directly, okay? But this is the formula. What's the formula for operating leverage? Contribution by contribution minus fixed cost. What is the formula for financial leverage? EBIT divided by EBIT minus interest minus PD divided by 1 minus tax is only for PD. What's the formula for combined leverage? Contribution divided by contribution minus fixed cost minus interest minus PD divided by 1 minus tax rate. What is the formula for financial leverage? EBIT divided by EBIT minus interest minus PD divided by 1 minus tax rate. What is the formula for operating leverage? Contribution divided by contribution minus fixed cost minus fixed cost. What is the formula for combined leverage? Contribution divided by contribution minus fixed cost minus interest minus PD divided by 1 minus tax rate. In order to do all this calculation, we'll do this income statement. Starting with sales, less variable cost, contribution, less fixed cost, EBIT, less interest, tax, EBT, less tax year. So till this is marginal costing. Beyond this is financial management. Beyond this is the financial management. Beyond this is the financial management. Any doubts on this? There is some miscellaneous area, but to me the chapter is over now. To me the chapter is over with this understanding. We have not done question. I'll do the questions. I'll do the question. But the chapter got over at this stage. Whenever you are going to revise this initial 30 minutes, or I think I spent 45 minutes, this you go through, chapter is over. That's all. There's nothing beyond this in this chapter. Any doubts on this? Able to understand this? Clear? Got clarity? We'll take a break. Post the break, I'll do the questions. Okay. Any doubts on this? Any doubts on the concept here? I'll just repeat one more time. Operating leverage, financial leverage, combined leverage measures that the rewards are going to be disproportionate to the efforts being taken. The reward can be measured through EPS. The reward can also be measured through EBIT. For operating leverage, EBIT is the reward denominator, effort is the sales. For financial leverage, the reward is EPS and the effort is EBIT. For combined leverage, the effort is sales, the reward is EPS. Percentage change in reward by percentage change in effort. This is another formula. Percentage change in reward by the percentage change in effort. Other formula is what is creating it? Contribution divided by contribution minus fixed cost. Financial leverage, contribution minus fixed cost is the numerator. Denominator is contribution minus fixed cost minus interest minus your PD divided by 1 minus tax rate. Combined leverage, contribution is the starting, contribution minus fixed cost minus interest minus PD divided by 1 minus tax rate. PD divided by 1 minus tax rate. Able to understand this? Any doubts on this? Got clarity? Done? Clear? Okay, we'll take a break now. One concept was pending. Okay, miscellaneous areas. There are two things which you need to be aware of. One is called net fund flow of a company. What is net fund flow of a company is, if I do business, I earn profits out of the business. So that is what I get from the business. But in the profit calculation, we subtract depreciation, and depreciation is a non-cash item. So overall, I earn PAT plus depreciation, and I'll use that for different purposes. I can use the PAT plus depreciation to pay preference dividend, to pay equity dividend that is gone out of the business. Okay. After that, I may use it for buying some inventory, buying some fixed assets. That is the retained one. So net fund flow is equal to PAT plus depreciation minus the equity dividend minus the preference dividend. This money can be now used by the company for buying some fixed assets or for buying some current asset. One thing you need to be very clear in your thought processes: if anything is increasing in asset side, something has to increase in liability side. There can't be an asset increase without a liability increase. Liability can be equity capital also, or reserves and surplus also. So here we are trying to understand how much is the money available from the company side for meeting its fixed assets requirement or your current asset requirement after paying the equity dividend and preference dividend. Very simple calculation. We'll see that in a question in some time. Second part is there's something called as nature of financial leverage. What is leverage is, one way of understanding the term leverage is basically the reward being disproportionate. Another way the companies will say, we are a highly levered company or not a levered company. Leverage also indirectly mean debt. Leverage also means debt, and financial leverage means debt in a company. Not preference. I'm not talking about the preference. Okay, preference can also come. Sometimes it is good to borrow money. Sometimes it is bad to borrow money. For example, my ROI. What is ROI? EBIT divided by debt plus equity. EBIT plus debt plus equity. I earn 10%. So I earn 10% on the debt also. I earn 10% on the equity also. Put together, both I'm earning 10%. The denominator is debt plus equity. For example, I'm earning 1 lakh. Debt is 5 lakh. Equity is 5 lakh. Now, on this debt, if I pay 12% interest, the other 5 will get a very low amount because you are earning only 10%. On the 5 lakh, if you pay 12%, which is 60,000, leftover 40,000 will be on 5 lakh, which is only 8%, which is only 8%. So, a debt is favorable for the company if the ROI, which is 10% in my example, is greater than the cost of debt, greater than the cost of debt. If my business earns 5%, don't borrow money at 8%, because in order to pay that 8%, you have to cut down on the return for the equity guy. You have to cut down on the returns for the equity guy. It can be other way around also. ROI 25%. I earn on 10 lakh, 2 lakh 50. I pay debt guys only 10%. Balance 15% what I could have paid to the debt guy, I take that. Equity guy also will normally get 25%. Put together, I'll give them a very high return. Put together, I'll give a very high return. See, ROI 10% means you are earning 10% on the money which you borrowed, 10% on the money which you got as equity. Money doesn't know whether it is debt or equity. Okay, you're earning 10% on debt, 10% on equity. If you pay 10% on debt, equity also you can pay 10%. If you pay 12% on debt, equity guys have to tell no, you have to compromise your return. You have to compromise your return. Debt guys, you are paying only 5%. Equity guys, you can pay surplus. So if my ROI is greater than cost of debt, it is beneficial for me to borrow money, and it is a favorable financial leverage. Favorable financial leverage. ROI less than cost of equity, unfavorable. In this comparison, ROI should be pre-tax, cost of debt should be pre-tax. Or ROI should be post-tax, cost of debt should also be post-tax. What is post-tax? Do into 1 minus T at EBIT, and interest also do 1 minus T. Interest also do 1 minus T. EBIT also do 1 minus T. Able to understand the concept? There are practical world. Lot of people may not borrow money or may borrow money. It all depends on what can you earn out of the borrowed money. See, Bharadwaj Institute borrows money. They have to pay interest at the rate of 12%. With the borrowed money, we'll put that money in constructing another classroom. When I construct another classroom, I'll get more students. So I borrowed 10 lakh. With that 10 lakh, I earn EBIT of 2 lakh. Then I can afford to pay interest of 1 lakh 20. I can afford to pay interest of 1 lakh 20 if it can earn EBIT of 2 lakh on 10 lakh. You're not able to generate that amount of profit. No point in borrowing the money. No point in borrowing the money. ROI greater than cost of debt, favorable. ROI less than cost of debt, unfavorable. Clear? Any doubts in this? Only rule is very simple. ROI pre-tax, cost of debt pre-tax. ROI post-tax, cost of debt post-tax. Which one do I follow? Your wish, no problem. But consistency. Only thing is you have to be consistent in comparison. Any doubts on the two concepts? With this, the chapter is over. With this, the chapter is over. Clear? Any doubts in this? We started with understanding what is leverage. Participate. Leverage means what? Reward is going to be disproportionate to the efforts being taken. Reward can be measured through what? PAT or EPS or EAES or EBT, whatever name you want to call. And the effort is measured in terms of sales. What is disproportionate? Sales 10% up. Sales is 10% up. Reward is 20% up. Reward is 20% up. Then we saw operating leverage. Operating leverage arises due to marginal costing chapter. or arises due to cost accounting or arises due to operations, arises due to operation. Till EBIT is cost accounting, EBIT till EIS is financial management. So till cost accounting, what happens is operating leverage. Formula is contribution divided by contribution minus what is creating OL. What is creating OL is fixed cost, or percentage change in the last item of cost accounting, which is EBIT, divided by percentage change in the first item of cost accounting, which is sales, marginal costing format. There you use the term profit. Everywhere it should not be profit, it should have been EBIT there, but we use the word profit and close there. So percentage change in EBIT by percentage change in sale, or 1 divided by margin of safety, 1 divided by margin of safety percentage, okay, not rupees, percentage. And what is margin of safety? You can do 1 minus break even sales percentage, or you can apply the formula profit, all that you can do, okay. Then we learnt something called, and the interpretation is OL of 5 times would mean that sales increase by 1%, EBIT will increase by 5%. Then we saw financial leverage, which arises because of cost of capital chapter, which arises because of cost of capital chapter, because in cost of capital we learnt that capital means long term money, and it can be from what? Equity, it can be from debt, it can be from preference. There are practical certain companies who don't have debt, who don't have preference, like Tata Consultancy Services. FL for them will be one time. One time means EBIT and EBT will match. Still, they may have some finance expenses in their P&L, that is bank charges. But technically, EBIT by EBT will be one time for them. It will be one time because there will not be any difference between the two. Here we learnt FL formula is EBIT divided by EBIT minus what is creating. What is creating is interest minus PD. PD alone divided by what? 1 minus tax rate, or percentage change in the last item. Last item of financial management is EPS. Percentage change in the first item is EBIT. Proxy for EPS is EA, ES. Proxy for EAs, if there is no preference dividend, PAT or PBT. Many question PBT and sales linkage they'll ask. PBT and sales linkage rather than EPS and sales linkage doesn't matter. Doesn't matter. Then FL of 2 times would mean that if EBIT increase by 2%, your EPS will increase by 4%. EPS will increase by 4%. Then we learnt a lot of MCQs are there. Please practice all those MCQs. Some of them have come in exam like September 24 exam, but all are very simple. You keep practicing the MCQs part. Then we did combined leverage. Combined leverage is linking what? Operating and financial leverage. Multiply them together in case there is no rounding off difference, or numerator of operating leverage. What is the numerator of contribution divided by denominator of financial leverage? What is denominator? EBIT minus interest minus PD divided by 1 minus tax rate. And this connects the first item of cost accounting sales, last item of financial management, which is EPS, percentage change in EPS divided by percentage change in sales. Then comes the format which we use: sales less variable cost, contribution less fixed cost, EBIT less interest, EBT less tax, EAT less preference dividend, EAES number of equity shares, and EPS. This is the format we follow. Almost this. Many question will stop at EBT, tax is there at EAT, preference dividend is there, EAES, or number of equity shares there till EPS. Till EPS. Okay. Number of equity share go till EPS. Any doubts on this? And miscellaneous areas, we once saw net fund flow. Net fund flow is equal to what? PAT plus depreciation minus equity dividend minus preference dividend. PAT plus depreciation minus equity dividend minus preference dividend. And the other thing which we saw is whether the financial leverage is favorable or unfavorable. Calculate ROI or ROCE, pre-tax, post-tax. I leave a choice to you. Pre-tax means EBIT divided by debt plus equity plus preference, or EBIT into 1 minus tax rate divided by debt plus equity plus preference. If you have done pre-tax, compare with pre-tax interest rate. If you have done post-tax, compare with post-tax interest rate. With this, the chapter is over. Any doubts in the chapter? Any doubts in the chapter? Very, very limited. Even other chapters in FM, so questions can be more. What you should focus on is the concept book. Read multiple times so that you get grip. Any doubts in this? Clear? We'll end with this thing.